Welcome back to the channel, folks. This is Jason, certified financial planner and host of Fighting Words Financial. Today, I wanted to talk to you guys a little bit about some thoughts that I've been having about Cathie Wood and Ark Invest. And I want to challenge some of the concepts and bias that I'm having myself in this conversation here, because I don't want to get trapped in sort of a hero worship cycle. I can count on one hand the number of celebrity investors that have popped up in the last 20 years that I've been in this business that still have the same level of standing that they had 20 years ago. Because the reality is that most active mutual fund managers and active ETF managers, they may outperform the market for a short time, but over the long term, they revert back to the mean and start underperforming their markets. Now, Cathie Wood is looking at markets and looking at investments in a way that has not really been done before. It's a way that I certainly bought into, and I did want to acknowledge that as a bias on my part. But I am a bit of a contrarian, and this channel has gotten a reputation for not simply being a channel for bias confirmation. It's something that challenges the way that you think and the way that you perceive things. And I want to continue in that, and I want to talk about some of the things that I'm thinking about Cathie Wood right now. I had a meeting with a potential client yesterday, and I didn't intend for this to come up in conversation, but it did. I started talking about how we have not really seen Cathie Wood tested. In the early days when she was tested in a way, but we haven't seen her take that long-term test where the markets are down for a long period of time and she sees giant capital outflows out of her funds, right? She was certainly tested in terms of how she was perceived in public media, how she was really abused and bullied. I mean, people called her Crazy Cathy. There were actually people that laughed at her on air, through mainstream financial media. What I'm talking about is we haven't really seen the market get crushed over a long period of time and seen whether or not her commitment to her long-term vision is really there. So here's what I wanted to talk about a little bit today. So a couple of things. Everyone talks about how Cathie Wood is the next Warren Buffett. I'm not sure that comparison should really be made. Their style and philosophies of investments are very different. Warren Buffett is a value investor. Cathie Wood is not a value investor. She's a growth investor. Not only that, she bases her growth model around Wright's Law, where she's looking at technology adoption curves, she's looking at cost declines, and that sort of thing. It's very, very different than the way Warren Buffett looks at a company. He's looking for established companies with these moats that are going to do business and grow incrementally over years, while Cathie Wood is looking at explosive growth companies. So just in that respect, she's taking a lot more risk in terms of her investments and taking a lot more risk to reputation with the moves that she makes. And in past cases, that has always eventually come back to bite these sort of celebrity investors. So I do want to keep that in mind. But here's the thing that worries me that I'm not worried about with Warren Buffett. Warren Buffett is absolutely 100% okay with having people think that he is an idiot over the short term, only to be proven once again a genius in the long term. There have been many, many times where he has made an investment and people asked why he did this. They thought it was the wrong thing to do. They thought it was even a dumb idea to do. And years later, he's proven correct. We've seen a little bit of that with Cathie Wood, but Cathie Wood's company has only been around since 2014, and it hasn't really seen the sort of cyclical test that Warren Buffett has been through many, many times. I wasn't in the business back in 1987, but in 1987, Warren Buffett made a series of giant investments, and immediately afterwards, the market declined by 25%. It was really bad. 1987, in retrospect, doesn't look very bad, but if you talk to people that were involved in the market at that time, it looked like the end of the world. Something like half of all financial advisors who were in the business in 1987, by the end of the year, they were actually out of the business. They had left being a financial advisor simply because the environment had gotten so tough. The market actually recovered by the end of the year. But in that time period, there were a lot of people that were saying very unkind things about Warren Buffett, and he shrugged it off. He basically said he didn't even really notice it. And to some degree, Cathie Wood has done that too. But Cathie has not been through a sort of long-term test like we had with investment philosophies back in 2000, 2001, 2002. That's when the market was down 9% in 2000, 11% in 2001, and 22% in 2002. So that's 3 years of declining markets. And that was things that were completely out of control of money managers at that point. That was 9/11, that was dot-com bubble bursting at the same time, and economic disruption due to a number of other factors, right? So all of that is completely out of the money manager's control. It had nothing to do with actual choices of securities, or very little to do with that. But there were a lot of mutual funds in that period that failed or saw giant capital outflows in that time. And there were some mutual fund companies that tended to prosper. The mutual fund companies that prosper, I'm going to bring up one example, and that was American funds. American funds, a few years ago, I don't know what it's like now, but a few years ago, if you walked into a bank, the first thing they were going to offer you was an American funds mutual fund portfolio. You pay an upfront commission. Everyone hates eating that upfront commission, but I'll tell you, their mutual funds are actually fairly solid. But the reason their mutual funds are solid is because they compensate their money managers based on a 4-year, 8-year, and 16-year rolling schedule. So there's not as much short-term incentive as there is long-term incentives, because you get these bonuses based on your 4-year returns, your 8-year returns, and your 16-year returns when you're compared against your peers, right? So that focus alone has made it less likely for those money managers to focus on short-term return. So Cathy Wood already does quite a bit of trading around her core positions. And in fact, she's bragged about this in interviews where she talks about generating 30 more basis points, 40 more basis points, 50 more basis points return than the stock actually had for the year based on the trading that's done inside of the fund. You think in some cases that's what you want done, but what if you're wrong in those trades? And when I say that, everyone says, oh, well, she's never going. It's wrong all the time. People are wrong all the time. Professional money managers are wrong all the time about trades that they make. And this is one of the reasons they all eventually sort of fall off of that popularity bandwagon. Only the ones that are strictly focused on that super long-term return, right, where their holding period is theoretically for 5, 10, 20 years, those are the ones that end up being successful over a lifetime. So I've been thinking about this, and I own a bunch of Ark funds. I listen to every word that Cathy Wood says, but I don't want to get carried away in the cult, right? I don't want to think that everything she says is always. I'm not going to go all in on anyone or all in on any company. I would never do that. Like I said before, guys, I worked at several different companies that I thought were the greatest thing on the planet, and they went under. I've invested in several stocks that I thought were the greatest thing on the planet, and they ended up going under. Be a little cautious when it comes to the next economic downturn we have. How is she going to manage a large outflow that not just lasts for a few months, not even lasts for half a year, but lasts for a year, year and a half, 2 years? Warren Buffett doesn't have that same type of concern because his company doesn't trade in the same way. With an ETF, she reports every day that the trade she's making, she has to report on a daily basis the amount of inflows and outflows that her company has in terms of investments. So that's just based on the way the ETFs are reported. So this information is all public and puts pressure on people. I'm interested to see how she responds over time. If she loses money for 6 months on a fund or a year on a fund, is her strategy going to change so radically in order to shore up that portfolio on a short-term basis that it damages long-term returns? That's what I'm interested in seeing. Actually, I'm completely uninterested in seeing, because that would mean that I would lose money in that short term, and I don't want to do that either. But it would be interesting to know whether or not she's going to have the discipline to stick to her guns with her strategy over a long period of negativity. And anyway, folks, those are just some thoughts that I was having today about that. Like I said, I'm still a fanboy of hers, and you can share your thoughts with me below. You can tell me how wrong you think I am. I look forward to hearing from you guys. Thanks again, and I'll see you next time.